So welcome to today's lesson. We are going to go through margin trading, understanding how your margin account works. So before we get into that, just as usual, we normally go straight to the assignment, just to do a recap on the questions which might not be correct, just to clarify, so that when somebody is going to review, you can at least have known what you would have written to get the question correct. So we're going to start with number 2. What time does the Tokyo session start in late November? The correct answer was 7 p.m. EST and 12 a.m. GMT. Actual open and close times are based on local business hours. This varies during the months of October and April, as some countries shift to from daylight savings time, DST. The day within each month that a country may shift to or from DST also vary during winter. So it is October, November to March, April. The Tokyo session starts at 7 p.m. EST, which is the same as 12 a.m. GMT. So 7 a.m. EST, 12 a.m. is the same. But of course, it was just a question to help someone be acquainted well with time frames and also what we talked about, the daylight savings time. The other question was question number 13. Yes, question number 13. In question number 13, yes, here. There was one of the following answers, which is the biggest disadvantage of going through a centralized exchange. We talked about the Forex market being a decentralized exchange. And when talking about centralized exchange, we're talking about exchanges like the New York Stock Exchange or Nairobi Stock Exchange, where stocks are traded. Low liquidity is not the biggest disadvantage. The biggest disadvantage is price manipulation. In a centralized market, there is only one entity and one specialist that controls price. All traders must go through this specialist. Because of this, prices can easily be altered to benefit the specialist and not traders. That's price manipulation. We saw the other day one of I think she's called Nancy Pelosi, who made a fortune when NVIDIA announced its earnings. And if you're watching carefully on the charts, NVIDIA was going lower during the previous day. But when the earnings were announced, NVIDIA gapped hugely to the upside. And that woman, I think she made in upwards of around $500,000 USD in one trade. So some of these things, we see them happening in the market, and we know is because of something called insider trading. So price manipulation is very evident in a centralized exchange. The other question was the last question, I think question 32. Let me confirm. Yes, question 32. True or false? It's impossible to get started in currency trading without a minimum account deposit of at least 1,000. That was a false statement. You can start any brokerage account with any money, even $50. We have traders who are even brokers who are even accepting $10. And XNS is one of them, and it doesn't have any minimum deposit. You'll find many having maybe a minimum deposit of 100, but there are very low barriers to entry in this industry. Okay. Yes. So let's continue to today's class. Today's class will be on margin trading. The thing that we're going to look at in margin trading, we're going to look at what margin trading is. We might have mentioned earlier. We're also going to look at what is account balance, what is unrealized P&L and or floating P&L, what is margin, what is used margin, what is equity, what is free margin, what is margin level, what is a margin call, what is a stop out level, trading scenario, margin call level at 100 and no separate stop out level. Trading scenario, margin call level at 100% and stop out level at 50%. Trading scenario, what happens if you trade with just $100? Different Forex brokers have different margin call and stop out levels. The relationship between margin and leverage, margin jargon, cheat sheet, how to avoid a margin call, how to choose a Forex broker, how do Forex brokers work, is a Forex broker a legit company, is the Forex broker licensed and regulated, what are you actually trading in Forex? Okay, so the lesson will run at least between 45 minutes to an hour. So in case you have any question, we are going to have the Q&A at the end of the class, at least 15 minutes at the end of the class, towards the end of the class. So what is margin? The biggest appeal that Forex traders offers is the ability to trade on margin. Now, what does margin really mean? We had mentioned it in the previous class, but to delve deeper, it just means the deposit which you need to put in your account balance so that you are given leverage. And when that leverage increases, the ability for you to enter into positions more than what you are put in the account, that is what is known as margin trading. And we looked at an example, and I'm still going to mention that example. Just assume you have 1,000 USD, which you have deposited in your account. Most of these assets, which are tradable, you cannot buy one unit of that asset. For instance, you're trading gold or XAUUSD. They're not going to sell to you one unit of gold or one unit of the dollar. Or if you're trading Euro USD, okay, so I can see a question here. So margin is basically a loan. Okay, we are going to look at them at the end, but I will answer that because I checked on it. So margin is just the ability, what you have been given is a strength to control a lot of money through leverage. So margin trading is the margin that you put in your account plus the leverage that you've been given. So that is what is called margin trading. Okay, so we can move on about that. So in essence, if you have an account of 1,000 USD or 1,000 euro and you deposit it in your account, what that means is that when you're going to transact in the Forex market, that is the requirement that that broker wants, or that is the money that you had and you put it in the account. So for you to be able to make any transactions, any buy or sell in the market, you would need a broker to come and help you out. Because with your mere $1,000 or $500 or $50, you might not be able to put in any size of a lot size. And I don't know if you have experienced this. You put in some money in the account, and then when you're going to execute, the broker, there's a pop-up on the broker's platform which tells you you do not have enough money. And what the broker might require you to do is to either do one or two things. Increase your margin, which is increase your deposit, or increase your leverage to match that position. That is what it will require you to do. So right now, we are mostly using, and I also personally use, MetaTrader platforms to execute. I use MetaTrader 4 in some instances, and in some brokers, I will use MetaTrader 5. What you see on the screen is a small screenshot of the section you see below MetaTrader 4 or MetaTrader 5. And there are some numbers which you normally see down there. Those are the numbers that we are going to talk about. And when I am teaching this subject, I like some interaction when you don't have any, when you have a question. So what you're going to do is what you just did previously and typed in, just write all the questions in that chat box. And when we are going to the end, towards the end of the class, I'm going to answer them. It will be easier for you to remember which question you wanted to ask when. So you can write it in that chat box and I will answer just as I answered the first one. So we have balance. And this is what you, when you put in the money in your account, you're not going to see most of these other numbers. These other numbers just come up when you execute. But assuming this is an executed platform, balance is 1,000 euros, equity is 1,000, margin is 500, free margin is 500, margin level is 200%. Now let's delve into understanding those metrics, because the metrics which you see there are equity, balanced, used margin, free margin, and realized P&L and margin level. All of those numbers that are below that screen when you're trading, they are all related and they change. One of the changes, if you execute, you're going to see the numbers change. So when you are in the market or when you're out of the market, you will see those numbers change. So we're going to talk about balance, use margin, free margin, and realized P&L and margin level. Sorry about the net. So what is an account balance? When you deposit your money in your broker's account, there is some money which you will always see down here. This is an example of MetaTrader 4. So there's an account you normally see down here. This amount you see here is what is normally your deposit or your account balance. So your deposit or the money in your account, which you can withdraw or add to, that is what is known as an account balance. So when your account balance goes down and you have some positions and you hear the broker tell you increase your margin, they're just telling you add some money into your bank balance or into your trader's balance. And we call this money risk capital. And you've had a very famous saying that only trade what you can afford to lose. This is basically what it means. The money which you put in your trader's account, if it is $1,000 or $2,000 or $5,000, if you intend to be a high-risk trader or a trader who uses full margin or likes to put large lot sizes, you have one or two options. Have a bigger account to accommodate those large lot sizes, or consider the money you put in your account as risk capital, as money which you can afford to lose. We're going to use $1,000 as much just for reference purposes. So as we continue the class, that is what we're going to use. So $1,000. So when you are in, what it means is that your balance in the account can only change because of one or two things. Number one, when you add more funds to your account, that balance will change. When you close a position, the balance will change either with a profit or with a loss. And that is something I know you have experienced firsthand in the market. Or when you keep a position overnight and you either receive a swap or a rollover. Now, when you look at your account down there, especially when you go into the account, for instance, when I was trading the other day, I left my account on and I was charged $92 swap because of holding overnight. So sometimes you will receive the swap, sometimes you are going to be deducted that money from your account. But we also have swap-free accounts, which are going to see some brokers advertising, and these swap-free accounts are normally for the people who come from the Muslim community, because they do not believe in charging these rates, just like they do not charge interest in banks. So this is how the swap would look like in an image. You have the balance, equity, and in this small white space in the account, you normally have something written swap. So this is an amount or a rollover. It is an amount that is charged or an amount that you've gained in an asset if you've bought or sold. So that is something that you will interact in the market quite a number of times. And anyway, most accounts do charge swap fees. It's a form of a commission, right? So what is unrealized P&L or floating P&L? Now, when you are trading, and I know that you have experienced this when you have set up an account and you press buy on sell, there are some numbers which you will see they are either floating in red or mostly in blue, or in some platform it's just all black. And they put in a negative or a positive if you're in profits or when you're in losses. So those numbers that you see dancing, either increasing to the upside in profit or to the downside in losses or drawdowns, that is what is known as unrealized P&L. It's an unrealized profit and loss, or floating loss, or a floating profit. So what is realized P&L? Realized P&L is the realized profit. When you decide, I am going to close this market at a specific level, or I'm going to close this profit or book this profit, that is what is called a realized profit or a realized loss. So only when you close open positions, that's when you're going to realize profit or realize losses. So when you add the realized profit or the realized losses, that will now make up your new balance in your account. Okay, good. So there's profit is not real until it is realized. And this is something that you will see in the market. You enter a position. Let me go to the charts. I want to give an example. You enter a position long. For this instance, let's talk about a position long. So you enter a position long in the market and you're targeting a certain area. And this market comes all the way to 50% of the move moves 50% of your market. And you are very happy. You had $1,000 and now your $1,000 is almost turning into $2,000. And when the market is in that level, you see $2,000. If you do not close that profit, it probably, and most of the time, is the last time you normally see that profit. Because as soon as you do not close it and the market goes against you, then you end up clocking at a stop loss and realizing a loss. So you maybe you would say, oh, the market went to my direction a bit. I saw the money and then I did not see the money anymore. And it is a common occurrence we experience in the market on a daily basis. So the only way is closing out your profits to realize your profits or your losses. When I am trading myself, I have taught myself how to cut my losers short and how to make my winnings and runners run. I add to positions, and I'm going to show you how this can help you realize more profits in the market. Okay? So let's go to the other part. The other part is what is margin. So when trading Forex, you are only required to put up a small amount of capital to open and maintain a new position. This capital that you put in your account is what is called margin. So it's just that in the Forex market, they are calling it margin. But anyway, in business, we call this capital. The capital I need to run my business. So this is the margin. It is money you need to run the Forex business. That is what is called margin. So so the higher the margin, or the higher the deposit, or the higher the currency you have to your account, the more you stand to make in the market. So when you put in $1,000, you leverage it up then you can control a lot of money. But instead of doing that, why not take $100,000 account, take a 1:30 leverage, and then trade safe. It means you cannot enter many positions that can be detrimental to your account. Okay, so we have margin requirement. So margin requirement, it is expressed as a percentage of the full position size, also known as the notion value. So when you enter when you want to execute a certain position, maybe in Euro USD, there is a percentage of the full position size which is called a margin requirement. So anytime you enter, there's money which is required to be set aside, okay, so that you can run that position. That is what is called a margin requirement. Okay, yeah. So about calculating margin, there are some calculations on the screen. We are not going to do most of these calculations when we are trading. Just understanding the concept is enough. That's why we are not going to go through that calculation. So the other thing is used margin. So what is used margin? So whenever you open a new position, a specific amount of required margin is set aside. So when it is set aside, if you can remember the first image or the second image we saw in our chart, we had something called required margin. So what you see down at the screen in the Forex, down here, you will see something called a used margin down there. And what it means is that that is the money that has been used to open that position. So in perspective, this is the big account that you might have of 1,000. And then they are going to set up an amount, and it is going to be indicated in your platform that that is the used margin. I can take a small risk down here just to give you an example. So let me set up a long position here. I just put in a very low lot size in the market, so I have that there. And if I want to risk, so I would put in maybe one lot, maybe one lot. So tools, new order, or 0.5. Yep. So I want to show you right now. Good. So let me pull my stop loss there. So this is for example purposes there. So for example, down here we have balance is 51,459.66. Equity is 51,459.28. This is fluctuating because when the P&L is adding in the account, then you will see this equity change in regards to if this is profit or this is losses. Right now we have fundamentals, and I think that's where the market is actually misbehaving with the fundamentals. Yeah, so yeah, it's 330. Good, it's 330. All right, so we have the margin down here, free margin down here, and margin level. So this margin is what was required. It's either called margin or used margin. It is what was required in this market for me to afford to put in this position. So that is actually what happened in the market. Let me close this because it would create some distractions in the market, but that is what will be required. So this is what is required margins. I just wanted to give you an example with a live execution. So used margin, all position down there, so they lock. When you open positions, they lock your margin, okay? Yes, so I hope that one is clear when you come to margin. So let's go through equity. What is equity? When we were checking into MetaTrader, you saw next to balance, we had equity. The equity was always changing because equity is normally what you have in your balance plus the floating PNL, or the floating realized or unrealized profit. That is what is called equity. So if you take your balance, maybe you had 50,000, for instance, you had 50,000, and then the market moved $1,000 in your profit, then you would have 51,000 as the equity, because it is actually the current value of your trading account when the market is actually fluctuating. That is what equity is all about. So when you want to calculate equity, you just take your floating P&L, either losses or profits, and then you will see the equity. What is free margin? Sorry. So free margin can be classified of either used or free. So when you're talking about free margin, it is what it refers to the equity in a trader's account that is not tied up in margin for the current open positions. So when you open a position and you will see free margin, it is the money that is not carried account. When I close my account, this is my free margin. My free margin is equal to my equity. It is equal to my balance when I don't have any position going on. But when I trade or execute, some of this free margin is gonna be locked up in the used margin section, and then the more I add more position, the more my free margin will decrease in the market. Okay, so free margin is equals equity minus use margin. So whatever you have in equity, the floating P&L, then you minus the used margin, then you're going to find free margin. So the other section that you're going to look into is margin level. Margin level is a percentage value based on the amount of equity versus used margin. Okay, so margin level allows you to know how much your funds are available for new trades. So I'm going to do a simple execution. I think the fundamentals are a bit over. Let me just use 0.25 as 0.1. Just to maybe purchase something. So 0.5, let me do 0.1, and then maybe buy the market, and then I have to put in my stop loss. Let me put in my stop loss at 38,605. 38,605. Okay, so I have my stop loss right there, and I wanted to drag in. It's fine. So we're looking at margin level. So when you're trading, you will always see a percentage on the market, this margin level. So this is just a calculation of what you can control. It gives you a percentage. So the lower the margin level, if you ever see your margin level go below 100, this is the number I want you to always keep checking to know if you're going to blow your account, especially when you are trading the funded accounts. Always make sure that this level you're trading is not anywhere close to negative 100. That is how you know if you're risking a lot or you're bleeding a lot in your market. When this level goes beyond a certain point, different brokers have different margin call levels. So when this level gets maybe at around 80, 70, 50, or around 10 or 20, they're going to give you either a margin call or a margin stop out. We are going to look at it just right now. That is the margin percentage where you see it live on the market. Sorry about that. There's an issue with the net. You can see it loading here. So what is a margin call? So a margin call level is when the level the margin level has reached a specific threshold. So when you are in the market and you have 100 and your margin level goes below a certain point, just as I was explaining to you, the broker is going to send you an email or whatever notification that you have set. And they are going to tell you either to do one or two things: close out the losing positions to save your account, or add money to increase your margin or the position in the market to hold the drawdown that you are in. So these levels, if they are breached, then you will find yourself being stopped out automatically by the broker. Now, when we are trading funded accounts, it is different from when you are trading your individual account. Your individual account normally maybe has, or most people who deposit the amount, deposit $1,000 or less. What happens, by the time a margin call level is breached and a support level is breached, the account is normally blowing or is going to zero because they had leveraged 1:500 or 1:1000, meaning their losses are amplified and they get stopped out. But now, when you are trading the funded accounts, when you are told, I am giving you 1:100 or I am giving you 1:30, the person being given 1:30 would receive a margin call earlier than the person who has 1:100 margin call level. Because when you breach some levels and your account is not healthy to hold that drawdown, the broker automatically closes your account for you not to lose more money than you had in your bank account. That is, or your trader's account. That is why they have the margin call level and the stop out level. These are to protect the broker from losing more money than you have deposited. But are there times when these accounts would go lower and you would owe the broker? Yes. If a crash happened or something outrageous like a fundamental happened in the market, then you would see such an experience happening. All right, so let's go to the next one, stop out level. So this is the worst of the worst. When you get a margin level and the account reverses to your favor, then you can save your account. But when your market gets to a stop out level, it means that you have left the broker no choice but to stop you out, because the next instance is that you're just going to blow the account. This is what happens in a trader's cycle when they are blowing accounts. When you see your account blowing, it means the broker just closed out your position because they were protecting themselves from losing more money than you have in your account. That is what is called a stop out level. Okay, so let's go to the next part. Sorry about the internet. I wanted to go through the margin call levels, maybe at support level, but I think by the explanation that I have given, you have understood what these margin call levels and stop out levels have in the market. So we're not going to go through those specific scenarios, but somebody would go through them if need be, or if you want us to revisit it at a specific later date, we will revisit some scenarios. But what I know is that I'm going to give you scenarios practically in the market when we get to trading. So they are not as important as we will discuss them, as we would practice them firsthand in MetaTrader 4 or 5. So the other part that you're going to check in is the difference between Forex brokers have different margin call and stop out levels. Now, just as I had mentioned earlier, you should know this, that not all brokers use the same blueprint for margin call and stop out levels. I told you that some brokers, especially brokers who are known to have big spreads and are in need to make a lot of profits, and some brokers who take the opposite side of a trader's account normally have different margin call and stop out levels. You would find that, an example, Pepperstone would give you a margin call at 100% and also give you a stop out level at 20%, meaning they will give you a leeway for you to blow your account. Some brokers will only allow you 150% as your margin call level, and when you get to 100% or lower than 100, they are going to stop you out from your position. So what I normally recommend is, when you take a broker, kindly write an email to them and ask them, what is your margin call level and what is your stop out levels? This way, when you monitor that percentage when you're trading, you would know how far you are from being margin called in the market. And that is actually what I do when I am registering with any broker. I go to the email section and I ask them, hi, I want to know what is your margin call level, and I want to know what is your stop out level, especially when I'm trading a small live account, because small live accounts are the ones which are mostly affected by margin call and stop out levels. And by a small account, I mean anything below 10,000 USD. That means that you're trying to make a lot of money with a very small account, taking advantage of leverage. So the relationship between leverage and margin. So you use margin to create leverage. Now, if you come up or you deposit $1,000 in your account, the only way the broker is going to give you leverage is when you deposit. So you deposit X amount, and then the broker is willing to X your amount. So that is the relationship between leverage and margin. So without margin, you cannot get leverage. And you can put in as much as you can in, you can execute big sizes in the market when you pick a certain size of leverage in the market. Okay, so we're gonna go through some jogging of our memories. So margin is the amount of money you are required to deposit with your trading platform in order to maintain positions in the Forex market. Margin is used as collateral. So it is whatever you deposit in your account. Leverage is the ability to trade larger amount with a very small account. So what we are doing, most of us traders, is leveraged trading. We have looked at unrealized P&L, which is the current P&L, which is floating, whether profits or losses. It's also called floating P&L. Balance is what you have in your account. It's the deposited amount. Margin requirement per position, so the amount required to open a position. So it is expressed as a percentage of the full position size. Then you have margin, required margin. You have entry margin, initial entry margin, maintenance margin required. Okay, so we have gone through margin call, stop out. I'm not going to go through that. So how do you avoid a margin call? So understanding what margin call is and how it works is the first step in knowing how to avoid one. Now, I know you have experienced a margin call. In our past experience, you told me an experience which was not so good, which you don't like talking about. but that is exactly what is referred to a margin call. It refers to when you entered a big position in a certain trade and your amount could not hold the drawdown. You bled and the trade went against you more, and at the end of it all, the broker just says, hey, I need you to add more money. But most of the time, before he even tells you that, the market is still going against you, and you find that you have no more money in the account. Now, I have seen margin calls even in big accounts. And by a big account, I'm talking about someone I know who had 100,000 USD and they over leveraged it and they did not use proper risk management, and margin call happened and the account went to zero. So these are things that happen in big accounts and in small accounts. So for you to prevent a margin call, have enough money in your account, use proper risk management, but at least ask your broker. And it's something that I know many traders do not do. They don't ask their brokers, what margin do I have in the market? At least now with what we are trading as funded accounts, you can easily ask those prop firms in their emails, what is my margin call level, so that I don't experience one, because they are also shutting accounts in that fashion. When you breach a certain number, or when you breach a certain threshold, or a certain percentage in a day, or a certain percentage in during the whole trading period, maybe 5% in the day, 10% in the whole trading period, then if you breach those two or any of those rules, they give you what is called a margin call. So know the margin requirements, know what margin is, use stop loss orders or trailing stops to avoid margin calls. You can scale in positions rather than entering all at once. You have seen me do this. When I am trading and somebody asks me, Kevin, why do you enter 50 positions? Or why do you enter 10 positions? What I do, I split my risk. And as I am becoming right in the market, I keep scaling in my positions. That's why you'll find me entering 0.5 lot size, and you will find me entering 5 lot size 10 times. Because when I was entering the trade, maybe I was required to enter with around 100 lot size, but instead of entering 100 lot size, I first entered the first 5 positions at the beginning of the trade, and when the trade started going in my favor, I keep scaling in the positions with the rest of the lot size required. So, of course, know what you're doing as a trader is important to understand. That's why we are here. I'm here to help you know what you're going to look for in the market, the risk parameters to use, create a trading plan, and these are things that we're going to help you not experience a margin call. Yeah, so how does someone choose a Forex broker? I know you have chosen a broker, and our interaction with you is that you are very dissatisfied with a certain broker who you told me, and it means that if you're dissatisfied, there are things that you have noticed that broker do that he or she is not having your needs looked after. For instance, you will find some shady brokers and some non-shady brokers. I have given you examples of brokers that I have used in the past who have helped me at least gain a good platform where I don't have to embrace a lot of hardships. But some brokers are shady. They are shady in their spreads, they are shady in their commissions, they are shady in the positions where they normally execute a trader, and so on and so forth. So we have brokers, some were called dealing desk brokers, and no dealing desk brokers. So you have dealing desk brokers who are market makers, and non-dealing desk brokers who are giving you an ECN. So when we're talking about a market maker, we said it was a broker who normally quotes his own spreads and quotes his own prices and puts a markup on the spreads. But non-dealing desk brokers, you will find that they're giving you direct from the interbank market. They give you the best prices. Yes, market makers, the spreads they give you maybe are constant, which is not a good thing, because sometimes if you're using an ECN, the spread can go up to 0 for some assets like Euro USD. Sometimes gold, you can have very low lot sizes to operate. Right. So Forex brokers, how do they actually work? We know that you deposit some money in your account, and what they do, they will give you a platform. Either they are going to allow you to trade to certain levels that you have, or ask you to put in some more money in your account, depending on what you are taking the account for. So for instance, you want to trade Euro USD, or you want to trade US 30. For instance, this is one of the assets I normally trade. And you can see there was some crazy fundamentals going on, but the market will still follow its structure. But what you normally have is, when you're talking about the brokers, sorry, the net is a bit crazy. Yeah. So what you do is, when you deposit your money in your account and the broker gives you leverage, there's a platform which you use in the back end, where they normally call a customer or client area. You are able to get your account, choose the leverage which you will use, and a broker will give you an account where you can execute. Now, when you execute from the broker, you stand to make profits or losses depending on the number of times you win in the market or the number of times you lose in the market. So the brokers just act as a bridge in the market to allow you to get positions in the market. Now, there's something you experienced a while back, and you asked me that you had put in some 2 positions during a fundamental, and it ended up in a loss, and they executed you, and it never touched your stop loss. Now, there is something called slippage, and this is something that you're going to experience. Whether you have your personal account, or you're trading a broker's account, or you're trading a funded account, it doesn't matter. You will experience negative slippage in the market. This is where you even put a stop loss in the market. I will give you an example. You have your entry, you have your take profit, and you have your stop loss. And you will see the market jump from the area where it is down here. And I'm happy that we have a scenario where the market just did that. I know you can see my screen if you can, and I want you to look at these last 2 candlesticks, this candlestick and this candlestick. When you look at this candlestick, you can see that this candlestick opened down here. I'm going to zoom in the price, and I want to show you a practical example. So let's say I entered the market somewhere above there, but I had my stop loss below here. What happens is you are going to be set up at a different price than you wanted the market to stop you out. So if the market jumps and opens here, this is where your SL will be. You will no longer lose 35 pips. You will lose at least around 45 pips. This normally happens, and you can find your account bleeding. Sometimes, and this is what I want to caution you, putting a stop loss does not mean that the broker will stop you out there. I want you to know that, so that you never leave your market unattended. I have seen scenarios, and I have experienced scenarios where I have put my stop loss, and I come to the market and I find the market trading below my stop loss, but I am still triggered in the trade and I am losing more than I was willing to lose. That is as a result of slippage. Sometimes also, you might want to execute the market there. But when you go to press buy, you look at your P&L and you realize that you are deep in losses and you just executed the market. It just means that when you executed, it coincided with the market gapping. And when it gapped, you are filled at a lower price or at a higher price. So maybe if your stop loss was in this level down here, around there, and you wanted to execute there, and the market jumps, the market is going to execute you lower or higher depending on what happened during that execution. And that is what is called slippage. It is something that happens. I've seen traders complaining in I've seen brokers complaining online in Trustpilot and in areas where we look at legitimacy of prop firms that they are slippage. But slippage will happen to you. It is not something that should not make you trade because it doesn't happen every day. But you will see it often than not happening in the market. And necessarily, it doesn't have to happen to you. So if you want to get a broker, there are some things which you will look at to know if those brokers are legit. Because some brokers, you give them money and they disappear. Just like in the prop industry, where you will put in some money and buy an account, and that proprietary firm, within the next 3 months, 4 months, or even an year, they are going to disappear with client deposit. So one of the things that we normally check is regulation of brokers and the jurisdictions that those brokers have been regulated. So I like looking, number one, at where those brokers are located. If it is located in countries that are not known to be legitimate, I am not going to use that broker and I am not going to use that proprietary firm. So most of the brokers that I use are Australian-based. I see markets, Blueberry markets. We have Pepperstone. Most of these are Australian-based. They have European licenses. They have US licenses. That means that I'm trading with a broker. Yes, we are going to experience slippage. We are going to experience other things that I can manage in the market. But if I cannot trust the broker with my money, it means I cannot deposit good capital as my margin in my account. So I like looking into ones that have that and know that my money is safe. So there are regulations, and I'm not going to delve into much into knowing which specific regulations have, but if you go through the Q&A section of these brokers, you can interact with them and ask them for their licenses. So the more the broker is licensed, the better. And the more they are licensed in many countries, the better. So most of Australian brokers are licensed in the US, licensed in the UK, licensed in Africa. Some of them are even CMA or Capital Markets Authority regulated in Kenya. And those are the ones that I like using, so that if I experience any challenge, I can write letters to this organization to see if I can recoup my money. Okay, so the reason why we actually trade and is to actually speculate in the market, but you have to have a very strong reason why you actually want to trade. I know very many traders who want to trade this market, yes, and I interact with very many traders. But now when it comes to the real reason why a trader wants to trade, I like requesting a trader to be very, very keen on why you want to trade. For instance, going through all this theoretical information, most things is not what very many traders like doing. Many traders don't like going through this information. And I had the same experience. It's because I came into the market with very wrong ideas and very wrong reasons why I wanted to trade. Of course, we all want money in the market. But in my experience, this business, which can get you rich fast, is also the same business that can leave you very frustrated very fast. So as we are moving on, I hope to build more trust with you. I hope to build more calmness. I hope to build more discipline. I hope to build more patience with allowing the process to unfold day by day. It is very easy for me to just come and show you everything. But as we are moving, I want you to write somewhere down on a book, why do I want to trade the Forex market? Be very genuine with yourself, because it will be a journey where there are so many things you're gonna like and so many things that you're not going to like. But all in all, I want to harness an individual who knows at least some jargon here and there, know some pairs here and there. Then when we get right into the business of trading and going into the charts and the analysis, then I know that when we are talking some terms in the market, you will be well versed. So that is the end of today's lesson. If you have a question, the floor is open to you.
Okay. First, I want. Yesterday we were supposed. There's a topic.
Yes.
Yes. You were supposed to tackle, and actually you said that's the topic I like, and I think we forgot to mention.
Okay.
Okay. But I can't find it. Your experience with Forex and your advantages. There's something like that, right? I remember.
Experiences with
Forex.
Yes.
And yes, I think we didn't talk about it. I remember you saying I like that part.
Yes.
And yes, kama skip, sindio?
Hatukusikia, nilisema tutaifunza the same one whole day with my experiences. Yes.
Oh.
Yes. Yes. We didn't mention it. Okay. We just said we're going to go through the first week. There's an echo happening.
There's an echo happening. I don't know. Should I leave and then join again?
What I can do is when I'm speaking, ebu mute alafu finye nini yako spacebar. Ukitaka kuongea unafinya spacebar alafu una release. Ukitaka ni reply. You hold your spacebar.
You hold your like that.
Unaongea. When you want me
to answer, I hold when I'm talking, right?
Yes, you hold when you're talking.
Yes, you hold when you're talking. So now is it okay, the echo?
Alafu na release nikienda kuongea.
Okay? Okay. Okay, so when it comes to leverage and margin, yeah, I've tried to understand most. So margin is there's equity also. Equity is the amount that, is your margin plus the P&L, right?
Yes.
And then the margin is the money you put inside.
That's your deposit.
And then the leverage. Huh?
The deposit you put in your account. That's margin, yes.
Yes. And then leverage is example, you open an account and you want to use a margin maybe of 1:4. So they will allow you maybe to open. That's what I understand according to me. Maybe they will allow you to open if you have 1,000, and if 1:1, they will allow you maybe to open one trade and maybe with a certain lot size. And then maybe when you put 1:1 they allow you to put maybe even a lot of trades with the high lot size.
Yes.
Yeah.
Yes.
And then there's a free margin, which is the amount, which is your margin, and then equity, you minus, and then you get the free margin, right?
The used margin, yes. Used
The used
margin,
margin, yes.
Yeah.
Used margin,
get free
Yeah.
margin, yes.
get free margin.
Yeah. I think I get.
Good. So what
Good.
what I'm
So
doing
what I'm
currently
doing
is
currently
kindly
is
kindly
kindly mute.
kindly allow me to quickly to fix this.